Well, welcome everyone. We'll start here in about 15 seconds or so, but looking forward to sharing some information with you here on this today's webinar, Navigating the Changes, focusing on the 2024 federal tax updates. We'll also talk about a couple of things that are going to that are already part of the law that are going to phase in between now and 2026. So again, welcome everyone. Today is December 13th, 2023. Hope everyone is getting ready to have an enjoyable Christmas holiday and New Year. And hope everyone's gotten their Christmas shopping started. If you haven't, you better get on it right away. This is about the time of the year that I start getting nervous that everything I order on Amazon is going to come in time. But anyway, welcome everyone. This is a specially created webinar just to go over some of the most recent tax law changes that could impact you as well as most of our clients. I'm the founder of Providence CPAs. We are a national accounting firm. We have clients in almost every state. I think 43 to 44 states, actually 42 states, which I think there's 43 that actually have an income tax. I'm David Auer, and I also have Angie O'Day on the call. She is our client success manager, and I'll introduce her, or I'll mention her again at the end of the webinar if anyone is interested in reaching out to schedule a free introductory call to find out more about how we might be able to help you. So again, today is going to be focused on the federal tax changes. Obviously, there's a lot of changes happening at the individual state level that we won't have the time to cover today. Just as a quick disclaimer, everything we talk about in this webinar is not intended to push the envelope. It's we're really just going to be talking about what the tax law says, and so anyway, just as a disclaimer, just make sure that if you are going to rely on anything in this webinar, just make sure that you are talking to a professional who has a background in the tax law. We also are not going to, this is very unlike our normal webinars where we generally talk about tax planning strategy. So just to give you a little bit of background about Providence CPAs, we're a CPA firm, as you might know, one that we do accounting and tax, but we focus very heavily on tax planning. We start every new client engagement with a tax plan that covers over the next 3 to 5 years to see if we can help reduce their tax liability. Normally we can, and if it makes sense for us to move forward, then we then service that client or onboard them, implement the tax strategies, and then in addition to offering the tax return compliance services and the accounting services, we also then make sure that we have a good tax plan in place at the end of every year, just to help our clients keep their tax liability as low as legally possible. So what I want to do first is just jump into several of the changes that happened because of the normal indexing that the tax law allows. So this slide shows what the tax brackets are for 2024. As you can see here, depending on what your filing basis is or situation, single, married filing joint, or head of household, you can see what the various tax brackets are there on the left column, and then what the various amounts of taxable income that you have that would be subject to that income tax. As you can see, for a single taxpayer, the 37% tax bracket, which is the highest tax bracket we currently have, kicks in at $609,350, and for married couples, kicks in at $731,200. The reason that could be important is for individuals who go from being single and you have high income to being married. There could be a built-in marriage tax penalty, just because when your incomes are combined together and you file jointly, it may you may be actually being pumped into a higher tax bracket. As you can see below, trusts and estates from an income tax standpoint are also subject to a progressive tax rate. However, the income threshold is a lot less. So a trust or an estate moves into the 37% marginal bracket once they have taxable income over $15,200. Just also to note, these amounts, these brackets increased by about 4 or 5.5% over 2023. And if my reading was correct, we're hovering right around a 3.1% inflation rate for 2023. So this actually, this increase in the brackets worked slightly in favor of taxpayers this year. So just because of the inflation rate being lower than the increase in the brackets, so that could help a couple of people that are sitting on the fence of moving into another tax bracket. As far as capital gains income is currently taxed at a lower rate than ordinary income tax, but it does depend on what amount of income and what your ordinary income tax bracket is. The maximum capital gain rate currently is 20%. And you can see the amount of income that you need to have in order to be subject to that rate. If you can keep under that 20% threshold, then the next level down is a 15% capital gains rate. And potentially, if your income is not above the lower thresholds, depending on how you file your tax return, it could be subject to a 0% tax rate. So some retirees who are able to keep their taxable income relatively low each year, and they have a stock portfolio or an investment portfolio that they can slowly harvest capital gains income. If with the right kind of combination, you might be able to harvest that capital gain at a very low tax rating all the way down to 0. So that's the capital gain rates. The standard deductions are also indexed up this year. For a single individual, the new exemption is going to be $14,600. That's up from $13,850. Married filing joint is $29,200, and head of household is $21,900. This comes in handy for those of you who have the ability through owning a business or other types of business activities or investment activities where you can put family members on payroll, such as minor children, and potentially shift some income down to a 0 tax bracket if you keep that income below the standard deduction amounts. Also, many taxpayers are subject to the alternative minimum tax. This sometimes creeps up on people who might have certain types of tax write-offs or benefits, certain types of deductions. Again, this exemption increased by about 5.5% as well. For unmarried individuals, it's going to be $85,700 starting next year, and married filing joints $133,300. But those exemptions start phasing out once you get over a certain amount of income. As you can see down below, it's a pretty high amount for individuals or unmarried individuals. It's $609,000, and married filing joint, it's over $1.2 million. So again, it's important to know these brackets and where the thresholds are, especially when you start entertaining tax planning, whether that's shifting income or deductions from one year to another. It also helps, especially when you're looking at options about deferring income, that if you have that option or putting or funding a retirement plan where you might get a deduction at today's rate. It's important to know what your tax rate is today so that you can evaluate whether it really makes sense to defer that income into a future year. Hopefully, knock on wood, that your tax rate is lower, but at the pace that we have been going on, I think most experts expect that tax rates will start trending up, especially maybe starting in the year 2026, which I'll talk about here in a little while. So those are the alternative minimum tax exemption amounts and the phase out. We also have a unique deduction that's been around now for about 6 or 7 years called the qualified business income deduction. So this is a 20% deduction against certain business income that you report on your tax return. You're allowed to just take this on the first page of your tax return. So it reduces your otherwise taxable business income. That deduction starts phasing out at a certain level. So unmarried individuals, the phase out starts at $191,000. $950, and married filing joint is $383,900. Also keep in mind that that this is I made a note here to talk about it. Also, there are certain additional tests that you have to make if you have specified service trade or business income. So, professional income like physicians, dentists, lawyers, CPAs, architects. There's a certain incomes that are subject to an additional a number of tests in order to qualify for the qualified business income tax deduction. But this is the general phase out that applies to all other business income. From a related point, we also have a gift tax exemption. If you didn't already know this, currently it's $17,000 per gift to a donee per year, and that's going to move up to $18,000 for the year 2024. So you can do a joint gift, so a husband and wife can jointly give next year a total of $36,000 to an individual donee. So just keep that in mind, especially as we get closer to a couple of years. The exemptions are going to be potentially dramatically affected or reduced for estate tax purposes, unless Congress acts in the meantime. As a segue to that is down below is the 2023 and the 2024 estate tax exemption, which also currently is our generation skipping transfer tax exemption, meaning that currently if someone died in the year 2023, they would not be subject to a federal estate tax, which starts at, or it's 40%, unless they had a taxable estate over 12,920,000 or 920,000. That's going to move up to 13,610,000 starting next year. It'll be adjusted for inflation again in 2025, one more year, and then as of right now, that estate tax exemption sunsets, and it will go back down to a $5 million per person exemption adjusted for inflation. So it may end up somewhere between the $6 and $7 or $8 million amount. But anyway, a lot of there'll be a lot of attention paid to this over the next couple of years, because families of wealth will need to start thinking about how to start transferring and avoiding some of this, having to pay a significant amount of their net worth in estate taxes if they don't have a good estate tax strategy in place. So for those of you who have minor children, or children under the age of 17, the child credit is staying the same. The only thing that's really changing is how much of that is now refundable. So it's generally the lesser of a fixed dollar amount or 15% of earned income that's in excess of a certain threshold. So it went from $1,600 last year to $1,700. Everything else related to the child tax credit is staying the same from 2023 to 2024, including the amount of income that either a married filing joint or other taxpayers have where they start the credit starts phasing out. Keep in mind, too, that we do not have currently personal exemptions like we had prior to 2018. So the child tax credit is in lieu of what we used to have in place, which is claiming your children as a dependent and as an exemption on your tax return. That will come back in the year 2026. Again, if Congress doesn't do anything. Just shifting gears from the tax rates, the next topic I want to cover is just some of the adjusted phase out rules for your ability to contribute either to a regular IRA or a Roth IRA. So on a regular IRA, the deductibility depends on whether or not the taxpayer is an active participant, and if you're married, then whether your spouse is an active participant. So as you can see in the top graph, the phase out for the deduction for a traditional IRA, if the taxpayer is an active participant for married filing joint, phases out from $123,000 to $143,000, and then single is $77,000 to $87,000. Married filing separately gets somewhat penalized because the phase out starts at $0 to $10,000. So if if you're married filing separate, you may reconsider filing that way if you are trying to deduct an IRA where you are an active participant in another qualified retirement plan. For those where you file a joint return and the taxpayer is not an active participant but wants to contribute to a traditional IRA, but the spouse is an active participant, you can see that the phase out range for a married filing joint kicks in at 230,000, so it's a higher than the above phase out to 240,000. And then as you may or may not know, if you have over a certain amount of income, you're not able to contribute directly to a Roth IRA over the last several years. So that phase out of the eligibility to be able to contribute directly to a Roth IRA starts phasing out at that same for married filing joint at the 230 to 240 range. Single is 146 to 161, and married filing separate again gets penalized because that phase out of being able to contribute to a Roth is much lower and phases out completely at $10,000. Now, with that said, the reason I said directly to a Roth IRA is there currently still is an exception to or another loophole, if you will, that did not get closed last year, which some people thought it would, but you can still contribute to a traditional IRA and then convert that into a Roth. However, there's something called the pro rata rule that you have to be careful of. So if you have other traditional IRAs, which includes rollover IRAs or SEPs or simple IRAs, depending on how much you have in that, a portion of that conversion when you go from a traditional IRA to a Roth IRA may in fact be taxable income. So here's an example where the other IRAs added up to or currently valued at $594,000. There was a non-deductible IRA contribution made into a traditional account that year, and then that was then converted over to a Roth. Even though it was reflected as a non-deductible IRA contribution, it in fact became taxable because of that pro rata rule. So as you can see down in the blue shaded area, if you roll 6,000 into the Roth in that particular situation, $9,000 or $5,940 is going to be taxable, which is that fraction of the $994,000 divided by the $600,000 total. So just be careful when you're talking about doing a backdoor Roth IRA. It is tied to how much you have accumulated in your other tax deductible traditional IRAs, including some of the self-employment IRAs. As far as retirement plan contributions go from last year to this year, a couple of minor changes. The IRA contribution limit went up $500. All of the catch-up provisions stayed the same, at least between last year and this year. The 401k deferral amount went from $22,500 to now be $23,000. So if you're age 50 or older, you can defer now $30,500 in a Roth or in a 401k plan. If you contribute to a simple plan, that went up $500, and then the maximum benefit in a defined benefit plan went up $10,000 from $265 to $275, and a defined contribution plan increased by $3,000 from $66,000 now to next year it'll be $69,000. So if you have W-2 wages and or self-employment income, and if you wanted to max out your contribution in the various types of plans, what I've listed here is the amount of either minimum W-2 wages you're going to have or self-employment income. So in the case of an S corporation solo 401k, last year you needed to have a W-2 salary of $174,000 to be able to max out the $43,500, which is the difference between the $66,000 and the $22,500 401k portion. Going into 2024, you're going to need to have a W-2 salary of $184,000 to max that out at the $46,000 contribution limit. If you're a solo 401k as a Schedule C, you have to reduce that amount of wages by half of the self-employment tax and then multiply that by 20%. But that requires you to have a $217,500 net Schedule C income in order to max out last year, and you're going to need to have a $230,000 net income after deducting half the self-employment tax in order to max the solo 401k. So if you are a Schedule C and you have that substantial amount of income, you may also want to consider electing or setting up an entity that is taxed as an S corporation, so that you might be able to control some of that self-employment tax and then pay yourself then a smaller W-2, which would be the example above in the S corporation solo 401k. If you're an S corporation and you have a SEP, that contribution is limited to 25% of your W-2. So that number goes from $264,000 last year of W-2 income that you'd have to have up to $276,000 in order to max that out. And then, and if you're a Schedule C, the SEP contribution, similar to the solo 401k for a Schedule C, limited to 20% of your net income after deducting half of the self-employment tax. So that number also, went up last year versus this year. So one of the calculations that I very much recommend that you look at when you're weighing how much to potentially contribute and what the related W-2 amount needs to be is also factor in the increased amount, excuse me, of either FICA or Medicare tax or self-employment tax that you end up having to pay in order to keep your salary high enough to max out the contribution. Then what you can do then, excuse me, is weigh the additional cost of the FICA or Medicare tax or the self-employment with what is the additional income tax savings that you're going to get by marginally increasing the amount of contribution. So for example, in the S Corp solo 401k situation, if you otherwise could pay yourself $150,000 salary and put 25% of that away in a 401k and the profit sharing portion of the 401k plan is the additional income tax that you're going to save by deducting 25% of 150,000 worth or increasing that to 184,000 W-2 is the FICA and Medicare tax that you pay on that additional income offset or wash away the income tax savings that you get by making a bigger contribution to the plan. So just be careful that it's not to just calculate or look at this from the perspective of the income tax liability, but also from the related payroll tax liability that you may also end up having. So for those of you who have a rental property or a business operation, as you may have found out the hard way, is the bonus depreciation deduction that was enacted in 2018. It was 100% for several years, and part of the Tax Reduction Act last year phases that out. So this year, that bonus depreciation declined to 80%, and it's going to decline again 20% per year until it phases out entirely in the year 2027. Now, what that means is that businesses prior to 2018 generally would still have an option to expense qualified equipment or purchases that they made by claiming what is still in the law, which is described as under Section 179 of the Internal Revenue Code. So that'll still be an option, which may now that the bonus depreciation amount is being phased out, may come back into life to where it may be better if you qualify under Section 179 to claim that expense deduction for depreciation rather than the bonus depreciation. For the last several years, generally the bonus depreciation trumped the 179 just because it was 100% and it didn't have some of the limitations that Section 179 had. So what I'm going to focus next on is some of the most recent changes that are going to impact 2023 and beyond. So again, this is the law that's been in effect this year. But just as a refresher, if you don't already know this, we had a limitation under the Secure 2.0 Act where charitable contribution deductions for certain types of conservation easements is now being limited to 2.5 times, which pretty much makes it a break-even proposition for someone who invests in a conservation easement, gets a 2.5 times possible deduction, and at a 40% tax bracket, they're basically just breaking even with their investment. Also to note is that the required minimum distribution age raised from 72 to 73 this year, and is expected to go up to 75 years in the year 2033. Penalties for missing your required minimum distribution decreased from 25%, which was pretty punitive penalty if you didn't make your RMD timely, down to 10%, with the caveat that you have to make the corrective distribution within 2 years. Also, what was a nice change for some was that the employer matching and the non-elective contributions that were made to certain qualified plans, namely the 401k, the 403b plan, or the 457 plan, can be made as Roth contributions as long as the employee is 100% vested when those amounts are contributed. So that helps some people who are really keen on trying to build up as much as they can into their Roth account. Sole proprietors. So as a general rule, most qualified plans by incorporated businesses have until the due date of the tax return, including extensions, to fund and a qualified retirement plan outside a 401k plan. If you're a sole proprietor, you can make that solo 401k deferral decision all the way up to the original due date, which is April 15th for most individuals, but that does not include any additional extension of time. So you need to make that decision by April 15th, whether or not you want to fund or create and fund a solo 401k for the prior year if you're a sole proprietor. The employers are also allowed to offer financial incentives such as gift cards to incentivize employees to make elective salary deferrals. Also, the Roth options also extended to simple IRAs and SEP IRAs. So that's a new change we haven't had in the past that came into effect in 2023. Again, it looks like Congress is really trying to provide some additional incentives for people to go ahead and put after-tax dollars away for retirement with the promise that that retirement income, when they take it out after age 59 and a half, will be income tax-free. We can continue to make distributions from IRAs directly to charities up to $100,000 a year. If you choose not to give it directly to a charity, you can contribute half that amount to either a charitable remainder trust, a charitable unit trust, or a charitable annuity. And then it also included a penalty-free distribution of up to $5,000 from a qualified plan for any kind of expenses related to a qualified birth, adoption, or for a domestic abuse. So those were a couple of additional changes that made access to retirement accounts and how you want that to be taxed if you want it to be in a Roth more flexible than more restrictive this year. So those were a couple of positive changes. Starting this next year in 2024, there is no longer a requirement that you make required minimum distributions from a Roth 401k or a Roth 403b plan, which is another reason why some people may who don't otherwise need the income may otherwise want to start shifting money over to their Roth 401k or Roth 403b if they are approaching their required minimum distribution age. The catch-up provisions for 401 and 403Bs and 457B plans can be treated or must be treated as Roth contributions for highly paid employees have compensation over $145,000. So any catch-up contribution, so that's the $7,500 example in the case of a 401k, if you're over a certain amount of income, must be made into a Roth as a Roth contribution, not a tax-deductible contribution. Employers can choose to match their employees' student loan payments as the equivalent of a matching. So for employees that are paying off student loans, they can still qualify for their employers to make an employer match to their 401 or 403b plan. And the 10% early withdrawal penalty no longer applies up to $1,000 if there's an emergency distribution under a certain definition of emergency, as long as that is repaid within a 3-year time period. And then the same type of plans can allow a non-highly compensated employee to defer up to the lesser of 3% of compensation or $2,500 for emergency savings account. So that is amount that they can defer as long as they are under certain income limitations. And that money can be set up in an emergency savings account that they can have access to without being subject to a penalty. And then another big change has happened in the area of the 529 plans. If a 529 plan has been in existence for at least 15 years, you can roll over any unused money up to the annual Roth IRA contribution amount, which is getting ready to be $7,000, into a Roth IRA for that plan's beneficiary, and that rollover is considered tax-free as long as no contributions have been made from that 529 plan for at least 5 years. So there's a holding period that you have to have that 529 plan be in existence, and then distributions not being made for another time period as well. So this applies to some older, more mature 529 plans where the children have perhaps, or the grandchildren have perhaps graduated from college, and now they're just trying to think about how to get that money out rather than being necessarily taxable. It now allows there to be a rollover into a Roth IRA option. So those are some changes that are going to start happening next year. Moving forward, if we looked on down the road in 2025, we'll have an increase in the amount that individuals that are 50 years or older can catch up on their 401ks and 403bs. That'll go from $7,500 to $10,000 a year, $5,000 for a simple plan. That number will be indexed for inflation after that, but it's only limited to individuals that are age 60 through 63. So somehow Congress took heart at that age group and wanted to give them an additional amount that they could start putting away. For some reason, they decided age 63 was old enough for that, so they cut it off at that age. If you're an employer with 10 or fewer employees that's been in business for less than 3 years, and you start a retirement plan after last year, so that basically is a retirement plan that was set up this year or later, you are now required to automatically enroll your employees and contribute at least a minimum of 3%, all the way up to 10%. That amount will increase 1% a year, starting this year. So that again is something to weigh as you're adopting a retirement plan if you're a small employer. And then retirement plans can now distribute up to $2,500 annually to any participant to pay their long-term care insurance premiums. So that again was not in the code until and it won't be effective until the year 2025. There are a couple of credits and additional deduction that I wanted to at least introduce. These are fairly complicated rules. Matter of fact, all of these changes that I have talked about, all of them have some unique or some nuances to them and some limitations, as well as additional instructions that you need to follow. So, clearly, if you follow up and are interested in any of these, either talk to somebody on our team at Provident, or make sure you talk to a qualified professional who understands what the rules are. There is a credit that's allowed for employers under 50 employees that has at least one non-highly compensated eligible employee, and that's defined as $100,000 or less. That you now can get a credit for the cost of setting up a qualified retirement plan. So the credit, it's a maximum of 100% of the startup costs up to $5,000. For employers that are beyond the 50 employees all the way up to 100, right now we have the current tax credit is limited at 50%. So that'll stay the same. So the original 50% rule that applied to everyone goes to 100% if you have 50 or fewer employees and you have at least one eligible employee. The credit applies to all the different types of qualified plans other than defined benefit plans. So for the most part, it's the cost of setting up a 401k plan, a 403b plan, a profit sharing plan, a SEP, or a simple plan. And generally, SEPs and simples don't cost anything. So, but those are included in the definition. There is also an incentive for employers to get a credit of the amount of money that they contribute to their employees' retirement. So that credit is up to 100% of the eligible contributions, up to $1,000 an employee for the first and the second year of the plan. The credit's reduced by 75% of in the third year, 50% in year 4, 25, and then it goes away after 5 years. The credit is available to employers, again, with 50 or fewer employees, and is phased out for employers with 51 to 100 employees. And then that phase out is, and the credit will be reduced by 2% of each employee in excess of the 50 employees. So anyway, good incentive to adopt retirement plans if you don't already have one for if you're a small employer with under 50 employees. So the next area that I'd like to cover before we kind of wrap up is what are some of the lasting effects from the Tax Cuts and Jobs Act. This was the act that came into existence back in 2018. This had some changes that were going to be phased in over a period of time. Like I mentioned before, bonus depreciation began phasing out this year 80%, and it's going to expire entirely at the end of 2026. In 2026, we're going to see some potentially big changes. One is that the lower tax rate, the marginal tax rate of 37%, will and that tax regime will expire, and we will go back to the previous tax brackets that we had prior to 2018, where the top rate was 39.6%. So that'll affect those people in just timing income and potentially deductions as it relates to, shifting income or deductions prior to, in the prior year to 25 versus letting the rates in 2026 affect it. We'll also have an increase in the standard deduction. As you may know or be aware, since 2018, we haven't had personal exemptions, and instead that was replaced by the standard deduction that was doubled all the way until 2026. That will go away, and we'll get back the personal exemption, and again, subject to a phase out for high income. So that may not be a benefit if you make too much income. And then the child credit will also go away because you'll have the personal exemption for children come back in existence. So a couple of things will happen, not till about 2 years, and depending on what Congress does between now and then. A couple of other changes that'll happen that'll impact most people is a lot of our clients that live in high income tax states or high property tax states can only deduct the sum of $10,000 per year as an itemized deduction. So a lot of clients pay a lot of taxpayers pay a lot more than that, $10,000 in combination of what they pay on their personal personal real estate taxes on their residence, as well as their income tax. That ceiling's going to go away. So that unlimited deduction of however much state income tax you pay and property tax will come back in existence. The alternative minimum tax reduction, where you go above the phase out, will expire. So that'll potentially eliminate the alternative minimum tax. Expose the alternative minimum tax to a greater number of higher income people. We'll also lose what has become one of our favorite business deductions, which is a free deduction of 20% for qualified business income. That will also expire in 2026. And now that basically means that all qualified business income now will lose a 20% deduction and now have to pay tax on 100% of that business income. And like I mentioned earlier, the state tax reduction will expire. It'll be replaced by a new $5 million exemption that'll be indexed retroactively. It'll be adjusted to inflation, as it grows from 5 million up to 10 million. So those kind of things to keep in mind. Again, these are high-level tax changes. If any of these pique your interest, I would definitely talk to somebody who's an expert and able to walk you through step by step. Just real briefly as we're wrapping up, wanted to introduce our process that we work with at Providence CPA. So like I mentioned, we start every engagement with our clients with a strategic tax planning engagement that allows us to not only review where the client's current year or past year situation's been, but also project out over the next several years where they envision their taxable income to be. And then we will come up with as many recommendations as we know about that could reduce that tax liability based on the client's goals and objectives. and then present that in a report that shows you the difference between paying the tax with no tax planning versus with these recommendations. And then it gives you a blueprint of basically, how we can help you reduce that tax liability going forward. If a client likes what they see, they can continue on in the journey with us and go through the onboarding process, and we're implementing the various tax planning recommendations. And then that is about a 60-day process of getting the onboarding, and then it can go all the way into the first year of just making sure everything is working and as effectively as possible. And then every year with all of our clients, we reach out to our clients to offer year-end tax planning, and to the extent that they want to engage us in that, we are proactively looking at everything that we can come up with to reduce their tax liability for the current year. So it's very different than how most traditional CPA firms work, where they're looking through their rearview mirror of where their clients have been, and they're just putting the right numbers on the right line on the tax return, after the end of the year. We instead take the approach that, looking through the windshield of where our clients are going, especially the high income tax bracket payers, where they have a lot more choices possibly to take advantage of, and just looking through the windshield and identifying what are the strategies coming up that they need to understand and look at to consider whether they should implement or not. So that's our process. If you would like to schedule a free introductory call, I have Angie on the call with us. She is our client success manager, and I have here either a QRC code that you can scan onto your phone to get a direct link to schedule a call with her, or you can email her at angie.o'day@providencecpas.com. Feel free to visit us at our website, providencecpas.com, or Physician Tax Solutions. We have a division of our firm that focuses exclusively on high-income physicians, and we have a lot of our recorded webinars that we've done in the past, on those websites. If you'd like to also look at those. So just in closing, I want to thank everyone again for listening to us, and to the extent that we can help you in any way, just feel free to reach out to Angie and schedule a call with us, and we look forward to hearing from you. Again, Merry Christmas and Happy New Year, everyone, and we look forward to talking to you soon. Thank you.